All right, in this lesson we're going to talk about classification of different costs. What we're really talking about is how these costs are associated when it comes to managerial accounting. Now, the reason why this is important is in the future here we're going to talk a little bit about what costs are associated with a product. So for instance, if we're using this product right here as pens and we manufacture these pens, we want to know what costs are associated with these pens. For instance, if we were going to sell these pens for $1 a piece and it comes to find out that it's costing us $2 to produce, then we're losing $1 for every pen that we actually produce. So it's important for us to understand the cost of a product so that we're not producing something at a loss, or management can make right decisions when it comes to sales prices. Now, there's three things that we want to kind of classify everything into based on these three topics. These are behavior, traceability, and function. And before we talk about those three topics, there's something that we do really need to talk about, and that's called capitalization. And kind of the basis of why we're doing this is this idea of capitalization. And the idea of capitalization comes up because of the matching principle. Now remember that the matching principle tells us that we match all of our expenses to the revenues that occurred. So for instance, if it took me $1 to build this pen, I would need to match the expense of this pen $1 with the revenues. If I never sell it, then I can't match it, therefore it shouldn't be on my income statement until I actually sell it. And so how we capitalize, okay, is that if it takes me $1 to produce this pen, I take the $1 and I put it in the asset account called inventory. And then when I actually sell it, I put that $1, I transfer that $1 from over here over to the expense, okay, account called cost of goods sold. But I only throw it over to there when I've actually sold it to match it. So the idea of capitalization is we're going to capitalize the cost to the asset and move them from the asset to the expense when we actually sell it in order to follow the matching principle. So that's capitalization. So now let's start talking about these three and how we classify a certain cost that we may incur in our business. The first one we're going to talk about is behavior. And when we talk about behavior, we're talking about whether it's a direct, a fixed or a variable cost. Okay? So let's start with fixed cost. Fixed cost tells us that these are costs that do not change with the changes in the volume of activity within a relevant range. And so when we say that, we're saying that when we incur the cost, it almost doesn't matter if we produce 5 items or 50 items or 100 items or 1,000 items. As long as we're within this relevant range, the cost is going to stay the same. So an example of this would be like rent. Let's say I need to rent a facility or a building to build these pens. Okay, I'm going to pay the landlord $5,000 a month in order to use the facility. It doesn't matter if I build 100 pens or 1,000 pens, I'm still going to pay the landlord $5,000. Now there's this idea of relevant range. Relevant range means that what's the capacity of that building before I have to move it to a new building or bring a new building online in order to produce more. You know, when we talk about, let's say, the equipment needed to make this, at some point we're going to run out of space and there's only so much so fast that the machine can produce. Therefore, if the maximum capacity is 1,000,000 pens, then I'm going to need to build a new facility or lease a new facility and get more equipment just to make 2,000,000 pens or 1.5 million pens or even just 1,000,001 pen. So we're not saying that it's always going to be fixed, we're just saying that it's going to be fixed to a relevant range. Now let's talk about variable cost. Variable cost is defined as the cost in which changes in proportion to changes in volumes of activity. So an example would be, again, going back to this pen, is that if I wanted to make 1 pen, I might need 2 ounces of plastic. And let's say that each ounce of plastic costs 10 cents. So I'm going to need 20 cents of plastic to make 1 pen. But if I decide to make 10 pens, I'm going to need 20 ounces of plastic, and therefore I'm going to need to pay $2 for plastic rather than 20 cents. So if it's variable in nature, it means that if I'm going to produce more, I'm going to need more. Well, we talked about within the relevant range. If I need, if I can produce 1,000,000 pens in my facility, I still am only going to achieve $5,000 in rent expense. Whereas if I'm going to make 1,000,000 pens, I'm going to need 1,000,000 times 2 ounces, which is 2,000,000 ounces, times 10 cents, which is $200,000 worth of plastic. Okay? So that's fixed versus variable. Let's talk about traceability, direct versus indirect. Let's start with direct. Direct tells us that these are costs that are traceable to a single cost object. What do we mean by single cost object? What is the actual product that we're producing? So when it's a direct cost, it's directly associated with the product. So for instance, what's directly associated with this product or producing this product? Well, the plastic, obviously, okay, the felt, the ink that's in here, and then we talk about something called direct labor. Let's say we have someone on the line that just takes the pen and the cap and puts it together. That is direct labor. They're directly associated with the manufacturing of this product. Now, indirect costs, on the other hand, are costs that cannot be easily traced to a single cost object or cannot be done due to the cost versus benefit. So let me give you an example. At the bottom of this pen, there's actually 2 pieces, and I'm pretty sure there's a piece of glue, or there's glue that's sealing these 2 pieces together. Well, I am not about to try to figure out how much glue we put on this pen and how much it costs, because it probably costs less than a penny to glue it together. So that's the first indirect cost. Is I'm not going to try to figure, I know that the customer gets the glue, but I'm not going to directly figure that out because cost versus benefit. Okay? It just, the cost of doing it is going to outweigh the actual benefit or the incremental benefit that I'm going to receive. The other indirect cost definition that we said was cost that cannot be easily traced to a single cost object. And so, for example, let's say we have a machine and it has oil that oils the machine. Well, I can't strictly identify it directly to this pen, directly associated with this pen. Therefore, it becomes an indirect cost because I can't associate the oil that we use on the machine to make the machine run to this pen. Okay? Now, the next one is function. In function, we're talking about product versus period cost. Let's start with product costs. Product costs are expenditures necessary and integral to finish the product or associated with the product. So notice that when we say product cost, it doesn't actually have to be the cost associated with the, that is this product. It can be associated with this product. Okay? Now, again, same example. What is product cost? The plastic is a product cost. Maybe the supervisor who's supervising it is a product cost. Maybe the person that's putting these caps together is a product cost. Those are the costs of the product, whether indirect or direct. And then finally, we've got period cost. Period cost is defined or refers to expenditures identified more with a time period than with the finished product. An example of that would be general administrative. An example of general administrative would be advertising. Okay? It's not directly associated with the product or even the manufacturing of the product. Now, one can make the argument that, hey, the advertising is an important function of the product. Well, I would agree with that. It's an important function of the product, but it's not because of the manufacturing process of the product. So when we talk about period costs, these costs are usually associated more with time than they are associated with the product, and they are usually indirect in nature when it comes to traceability. Okay? So before we kind of sign you off with this classification of cost, let's talk about some examples and go through these examples. In this example, we're talking about a bicycle shop or a bicycle manufacturer. And we're going to classify everything by fixed and variable, direct and indirect, product versus period cost. So let's start with bicycle tires. Now, bicycle tires in itself are variable in nature, because if I was going to produce one bicycle, I'm going to need 2 tires. If I'm going to produce 2 bicycles, I need 4 tires. If I'm going to produce 200 bicycles, I'm going to need 400 tires, and so on and so on and so on. So that's going to be variable in nature. Okay? Now, does the customer get to take it? Absolutely. So it becomes a direct expense, and it's definitely a product cost because it is directly associated with product, not necessarily time. Let's talk about the wages of assembly workers. It's going to be variable in nature, it's going to be a direct expense, and it's obviously going to be a product cost. Now, let's talk about wages of assembly workers. Let's go back to our pen here. We might have a person who literally takes the pen and the cap, puts it together, and then puts it in the box ready for shipment. Okay? Same thing here, wages of the assembly worker. Without that assembly worker, maybe the chain never gets on to the bike. So we need to have that labor in order for the chain to get on the bike so that we can have a complete bike to actually sell the bike. Okay? So it's variable in nature because we may only need that assembly worker for 1 hour a day because we are only producing one. But if we produce 10 bikes, we are going to need, let's say, 10 hours of labor. So variable in nature. It's a direct cost because that cost is directly associated with the production of the bike. And because it's directly associated, it becomes a product cost. All right, advertising. We talked about this a bit, but it's fixed in nature. It's an indirect cost, and it's also a period cost. Okay, so let's talk about the fixed in nature. Okay, now you could make the argument that because we are producing more bikes, we're going to need to have more advertising expense so that we don't have a ton of bikes in our inventory and then in storage. I get that argument, but from the fundamental level, advertising is a fixed cost. No matter if I sell 3,000 bikes or 5,000 bikes, theoretically my advertising cost should be the same. Okay? It doesn't matter if I produce 500 bikes or produce 1,000 bikes, my advertising would be fixed in nature. Okay? Now, they're indirect because they're not directly associated with the product. I don't need advertising to actually make a bike. Okay? So that's why they're indirect in nature. And it's a period cost because it's more aligned with time than it is with the actual product. Typically, if you're buying advertising for a period of time, not necessarily how many units you produce. All right, going to production manager wages. Production manager wages are typically fixed in nature. They are an indirect expense, but they are a product expense. Okay, so let's go over this. Production managers, typically wages are fixed in nature. Now this may be because they have a salary, so no matter if they work 1 hour or they work 40 hours or 50 hours a week, they get one wage. But also because typically if you increase the amount of, let's say, lines of service and they're all within 8 hours a day and that manager can oversee that within 8 hours a day, then we don't need another production manager. Okay? They're indirect because they're not directly associated with a product. Let's, again, going back to the management system. If they are managing, let's say, 2 service lines, they are not directly associated with, let's say, this service line versus the bike service line. They're associated with both service lines. So they're indirect in nature because they're not maybe associated directly with the product. And then it's a product cost because we do need that manager, that production manager we need because the company is saying that we need that production manager, let's say, oversee the workers of the assembly workers. Okay? Office depreciation. Office depreciation is usually fixed in nature. It's an indirect cost, and then it's a period cost. Okay? Now, office depreciation is fixed in nature because it doesn't matter if I produce 1,000 items or 5,000 items. Typically your office, your main office, your headquarters office will stay the same size. Okay? And it's usually fixed in nature because of the whole fixed variable when we said we're going to build a building, put the manufacturing process, no matter if we're going to make 1,000 pens or 1,000,000 pens, we're still going to give our landlord $5,000. Same thing here. Office depreciation is also an indirect expense. It's an indirect expense because it's not directly associated with the product itself. And then it's a period cost because it's more associated with period than product. Okay? Again, period than product. Now, factory depreciation or factory costs typically are fixed in nature. Okay? They are a indirect cost because they're not directly associated with this one product. They're associated with many products, just not this product. Okay? And then factory depreciation is a product cost. Now, Pat, how come this is period and this is product, but they're both both depreciation? Well, they're both depreciation, that's correct, but it's a product cost because it's the cost of the product. We need that factory expense in order to produce this product. I can't just produce this product out in the middle of a county street or a county road. I'm going to need a building to do that. So it becomes a product cost, not because of the time standpoint, but because it's directly associated with producing this good. I need that building in order to produce this good. I don't necessarily need office depreciation or office expense in order to produce that good. Okay? And it is indirect in nature because it's not directly associated with this one product, but we're going to have to take that expense and prorate that expense over all the products that we make. So that's a little bit about cost classification. It can be very difficult and it can be very confusing. The real key in this is to kind of understand the basic definitions of fixed versus variable, direct versus indirect, product versus period cost. And again, the more practice that you get, the better you'll get at it. I mean, sometimes I don't get it, sometimes, and I have to go through my own head and figure out, okay, is this indirect or direct, or is this product versus period cost? And so it does take a little bit of practice, but at the end of the day, if you understand the definition here, it kind of gives you a better understanding of filling this out and understanding fixed versus variable, direct versus indirect, product versus period cost. So that's this lesson on the classification of costs.